Welcome back, guys, ladies, to the channel. We're coming to you to give you an update on graph. I don't know how many out there hold graph, but I do support it. I do hold it. We're going to get through this intro. If you do like the channel, please subscribe and hit that like button. We look over here on graph, we're sitting at 0.0246. We're down today on the new day 0.24%. It's been 1 hour and 18 minutes on the new day. We have pulled down a little bit from we was up higher somewhere up around, we was our way up to 0 point, a little 3 cent, and we pulled back just under 2.5 cents. So we'll look here at the chart. Overall crypto market is bearish. I just did a video on Mega ETH, and it lets you know why. I can give you a short detail on it right quick here. I got some notes here. Right now, the U.S. bond market is under heavy pressure, and it's one of the biggest macro stories affecting crypto stocks and risk assets. The current bond market condition is treasury yields are rising sharply. 10-year treasury yield is around 4.65% to 4.67%. The 30-year treasury yield moved around 5.1 moved above, I meant to say, to 5.1%. That's extremely important because bond prices fall when yields rise. So, and rising yields tighten financial conditions. A 30-year yield is now at levels not seen since the 2008 financial crisis, and we're about to go into another financial crisis. We're right there, y'all. We're right there at having. If we ain't already in a financial crisis, we're right there. What this means, the market is pricing in persistent inflation, higher for longer interest rates. So when you go borrow money, you're going to have higher to longer interest rates, meaning you're going to be paying a lot more for what you're getting than you would have been if it hadn't been for this, what we're going through. Massive government debt and weaker demand for long duration bonds. Investors are demanding higher returns to hold U.S. debt. And you want to know why yields are exploding higher? Inflation fears. Energy prices, diesel fuel, gasoline. It's crazy what these prices is because of what our government's doing. Energy prices and sticky inflation are making traders think the Fed may keep rates elevated longer than expected, meaning that we could have an increase in interest rates, and that's just the straight up truth. I mean, you want to crash the market, raise interest rates, because Powell going out and the new guy coming in, it don't mean one guy calls the shot on interest rates. The whole committee, and Jerome Powell ain't going nowhere. He's going to continue to sit on that committee because he's stepping down, or they're removing him from being Fed chair and sending some guy in there because promising the Lord they ain't going to lower interest rates, not in this inflation that we in. The government debt supply. The Treasury continues issuing large amounts of debt, increasing supply in the market. Weak long-term bond demand. Foreign buyers and institutional demand or not absorbing bonds as aggressively as before. Possible Fed hawkishness. Oh, it's possible. It's more than likely. Markets are starting to consider the possibility that the Fed may delay cuts or even hike them again if inflation stays elevated. So, every time somebody comes to the table with a deal like Iran, there's no deal. They hurting us. We might be winning the war with weapons and manpower and air and sea, but they hurting us with our economy. What the yield curve is saying, the curve has been steepening. Short-term yields relative stable, long-term yields rising. That usually signals inflation concerns higher future borrowing costs. See what I'm telling you? When you go borrow money, it's going to cost you more for them to loan you the money on interest rates than it is, say, if we went in this economy, in this inflation era. And concerns over long-term fiscal stability impact on crypto. This matters a lot for crypto. Higher yields usually hurt altcoins, your favorite altcoin. Don't matter who it is, from Bitcoin all the way down to FART token, and the growth stocks, leverage trading. Because investors can suddenly get 4 to 5% of risk-free returns in treasuries, that pulls liquidity away from what? Risky assets. Who's that speaking for? Crypto. But there's another side. If bond markets become too unstable, confidence in fiat system weakens, debt concerns rise, liquidity injections eventually return, and crypto narratives strengthen again. That's why sometimes short-term bursts for crypto, long-term bullish for hard assets and decentralized systems. Current overall reading. The bond market currently looks stressed, inflation sensitive, and cautious. Whales just ain't coming back into the market. They don't want to put their money in there in a crypto or asset drop 50 to 75%. And guess what? Crypto being a risky asset, I don't care any crypto. It could be Bitcoin, it could be VeChain, it could be XLM, XRP. There's always a risk. If a token drops that far, it could be years before it comes back. Look at Luna Classic. It failed. It got nowhere near where it was at. The main signal right now is higher for longer rates and yield and until yields stabilize. Crypto rallies may stay volatile. Altcoins may struggle to fully break out, and that is what we are seeing in the current market. This is why, but graph has been holding up exceptionally well. Exceptionally well. Let's see if we can look at the daily chart. We did have a pullback here where it was at up there at 3 cents, the graph, and it pulled all the way back down to 0.2, a little under 2.5 cents. So you've lost over this pullback a little over half a cent. But it was nice when it was way on up here, you know. But I can't remember. My average in this token is 2.8 cents, somewhere like that. 2.8 cents. So I'm not bad off. Maybe as some others have been that held this from 40 or 42 cent. That hurts. But anyway, we could see a pullback. Let me go back to the 4. We could see a pullback back around 0.02414, 2410, 0.0234. Somewhere around this area to get back in this area right here of support right here. We wick down into it right there and bounce right up. So we have a good amount of support right here, decent support that we may end up falling just below this 236 at 0.0241. From where we at, we could see a slight a little bit more pullback. Then from there, depends on how long we consolidate down here into this support area, and then getting a rally and trying to get back up against up where right here we had support, which is resistance now. But we need to break above these levels, at least get above 0.0259 once we come down to consolidate to say, hey, this is a reversal. We turning back bullish again, and the market can get a relief rally. But I wanted to come and give you an update, hit that like button, and just don't come by and just listen for a few minutes and turn it off. Just subscribe to the channel. And if you hold graph, let us know in the comments. I'm going to keep covering it because I hold it. I hold a lot of it. So until the next time, we'd like to say we're glad you stopped by. God bless you, and we'll see you on the next one.